What's good, superstars? Back with another video. Today we're doing another living out of my brokerage account video. I am not quite yet living out of my brokerage account. Started this a little bit at the top of the market and obviously having some pullbacks. So this video here is going to be showing you a little bit of my rejigging, the plans moving forward, how I plan to get there. I know a lot of people on YouTube, they've been showing how they are living out of their brokerage currently, but never really how they got to that point. Growing an account, making sure that you have a decent healthy margin amount to be able to make up for the difference. Like when you put in your paycheck and pull it out, you're pulling it out straight from margin. If you're doing a one-to-one, if you don't have a spread between your paycheck and your expenses, there's different ways to go about it. Are you growing your margin at a decent enough rate? Are the distributions big enough to help pay down the margin to increase that spread? There's like a turning point, I feel like, at one point in time as your portfolio grows. And I think you need to have a certain distribution amount in growth versus the high yield, or maybe even just only growth at the beginning, just to be able to get to that point where the margin growth in the space that grows because your portfolio is growing at a certain rate outpaces that of the spread from your expenses, etc. So we're going to go through what we're doing now. As you'll see on the screen here, this is my portfolio breakdown. Originally, I had my target for growth at 40% and my high yield target at 60%. And you'll see the actual results there. My growth has obviously been growing towards 43%, and my high yield actually has shrunk because those high yield funds have been taking a little bit of a tumble here in the last week or so. So I'm thinking, because I'm so early on in the journey, I need to rejig. I need to start to focus a little bit more on the growth side, just to be able to have my portfolio growing at enough of a rate where the margin's growing at the same time the distributions that I have contributing to margin pay down kind of opens up that spread that I need to cover the difference from my expenses and my paycheck. So that's something that I need to work on. I think maybe even we're going to start to do one bill at a time, that type of thing. I know there's other people who do that online. So if I put in one bill at a time and slowly get more and more comfortable with it as we see the spread growing, if the growth starts to take place. Right now, with this big pullback in the market, I'm thinking it might be a good time to try. Might have a little bit of a lower equity position relative to margin by doing it this way. But right now, I mean, it's not like the portfolio is hundreds of thousands. So it's something that we could stomach just being a little bit more in margin than equity at this point. So anyways, I wanted to show you guys. So yeah, I switched it up, 60 growth and 40 high yield for anything new that goes into the account. I'm still deciding. If you haven't seen Fully Invested Fi's last video, he had a great idea with the distributions. He's putting them all into growth, or he has a potential scenario where he could put them all into growth. And then his he did a whole case study on it. It's pretty cool. You can see his projections look like great numbers. I'm not doing that quite yet. I think I'm just going to start this way by having a higher percentage going to the growth versus the high yield. As long as my high yields are covering my margin interest, I think for now I'm okay. And then I can always convert when I get a portfolio that's large enough that I can get my high yielders to the percentage or the amounts that I want based off of the size of the portfolio. So now that changes a little bit of things. I'm also going to be shrinking down my single stock in the high yielders. I'm just not happy with how those are performing. I'm watching them and they're just all over the place, and I want a little bit more consistency. So I'm increasing my high yield index funds, like your HHISs, your ENCLs, your USCLs, your QQCLs. Like, these are Canadian funds, but there's American funds too that are like that. So I think my broader indexes, I'm going to have a little bit of a higher percentage of the 40, 62.5%. 25% will be high yield singles, just because that helps bring up the distribution, which I feel like I need a little bit of. And then my commodity high yielders will be at 12.5%. Overall in the portfolio, it'll be only 5% and 10% for the single yielder. So I think that's a little bit better. Those yields, those are a little bit more volatile and only going to be really risking around 15% of the portfolio doing that. 25%, I think I'm going to start focusing, because there's a bunch of different broader indexes, but some of them are not as less volatile. Some of them are really volatile, so I think we're going to stick to the less volatile ones. We're going to have less yield. Like, our yield is going to take a big hit here, but like I said, as long as I'm covering the yield from my margin, I think for now I want to grow the account. So we're focusing on growth single, your Apples, your Googles, your Metas, those types of stocks. My growth indexes, my QQQs, my SPYs, the triple funds on those. I'm gonna have actually a whole um, idea for when market pullbacks happen, what my plans are for insurance. I know I have some put options on that are gonna help for immediate flash crashes, but I don't really love how they are if the market were to go down slowly over time, because it doesn't really give you that huge upside or cushion as much as I would like it. And a lot of the times, more than not, I feel like the market downturns are over a little bit of time rather than within a day or two. So I mean, that could always happen. There could always be something that happens that causes the market to drop 20% in a day. But I feel like more often than not, it's going to be the other scenario. And in either case, this idea I'm thinking about doing actually got from a Blossom user. If you're following me on Blossom, I can share their post. But anyway, growth commodities, that's like your gold and your Bitcoin. Right now, Bitcoin is getting killed. So I still want to have some in my portfolio. So I'm looking at 10% for that. And then growth in single stocks, and then 30% for the indexes. So that should be my biggest allocation, and it should make it a nice core holding. So that is the new spreads. Let me know what you guys think in the comments. Do you agree? Do you disagree? Do you think early on in the account building phase, growth should be prioritized? Is 60-40 not enough? I do still want to have like some base positions in the high yielders. Maybe when I do establish like a decent position that I would like in those, then I maybe lower this and increase the growth again. And then when we get to where we want to get, maybe go a little bit more aggressive on the high yields and maybe up the single or the more aggressive index funds and see how that goes. So here's a spreadsheet. I'm going to shrink this down a bit so you guys can see the whole thing. Oh, it's not even going to show you that. I've increased the spreadsheet width. So, I mean, it might be a little bit harder to see, but hopefully you guys are watching this on a big TV. Anyways, this is not my pay. I just put it in as a placeholder. I'm using the annual growth rate of 7%. This is going to look very familiar to Fully Invested Fi's spreadsheet breakdown. I did use his as inspiration. You definitely have to go check out his channel. He's doing a great job. Having a little bit of trouble with YouTube and their policies and stuff like that based off what he's posting. I don't understand why he's getting his videos struck. But anyways, definitely go check him out because he's been a huge inspiration for me. I love his videos. I love his explanations, very clear and concise. So if this does look familiar, very big inspiration drawn from his channel, but I've tried to change things up to my own purposes. So my blended yield right now, this is based off my dividend calendar, which I have there, which will show you like eventually. But right now, keeping that private. But 31.25% is the overall dividend yield. I'm gonna have that drop significantly because a lot of the funds that I'm planning to put my high yield funds into are sub 30% yielders, even sub 25, sub 20. Just because I want to get that base, that foundation set. I want to have a consistent margin space growth before I do this. And then this way, once I can start to get the paycheck in and I notice that I'm going to be able to sustain putting the paycheck in and withdrawing all the expenses, at that point, then I think I will start to become more aggressive on the yield side. But I think it's going to take some time just to grow the position. So that's something I don't think anybody really talks about. This one here, average monthly dividend add per paycheck, that's just based off of the paycheck, and which would be, I guess, this divided by 2 and then multiplied by the yield divided by the months. Inflation, I'm a little bit more aggressive than others. I say 4% inflation just because I want to see what happens. And then the expenses, I said, are equal to the paycheck, but at the same time, right now, I'm not trying to pay off the paycheck, so you're going to see that once I go through. And then cash, this just allows me to put the cash position that I have, and it adds to the portfolio value, total portfolio value. So anyway, right now you see this is November. We're going to have a dip on both of them if it were the month were to end now. Obviously, we've had a huge dip in the market. You can see my growth portfolio has not dipped too much. It's only down like $20, but the high yield has taken a big tumble, $1,000 it looks like dip, which makes the total portfolio value drop. And then obviously margin stays the same, if not increases. And then you can see that our margin, our equity is only at 47.75. So I always wanted to keep it over 50%. Right now, I'm not too uncomfortable being below that. And I do plan to add a little bit more to this account in the near term here. Trying to, like I said, grow certain other positions, try to get my percentages a little bit more in line with what I want. This month, I've only put in an extra $130 above what last month's distributions were, which is 287. So we're at 417 invested this month, and we're already more than halfway through the month. Expenses, I've only had $99, 68 of which, sorry, $70 minus the spread from last month, because I did a put option, and I had $1 something left, so I rolled it, and I only paid 68.67 for this month's SPY option. And then I also bought a budgeting spreadsheet, which maybe I'll show you guys one day, but I'm accounting for that. So that'd be my first expense that's being paid out of this. It's not a regular expense. I want to get more into the recurring expenses eventually, but trying to pull some stuff out of this account as we go here and see what happens. So that is the sheet. I want to show you guys now, if I were to increase the expenses, what happens to the equity. So for example, let's say I wait until we get to 55% equity before I decide to increase my my investment. So let's say I'm going to put $500 in above and beyond my dividends. So that seems like it's sustainable, because you see it start to go down, and then it starts to come back up, and then we get to 55% again here. So let's say 55% is our safe haven before we increase our investment into the account. So that's looking like that's working again too. I put it up to $1,000 above the distribution. So it's going to take some time if I go at this pace, basically to get to my full paycheck, which we showed at the top. We're assuming is $10,000. So if we keep it at 55, it's going to take a while before I could put another 1,000, let's say, in. And it's doing all right there. So maybe we put this to 4,000. Yeah, look at that. So it's actually handling that pretty well. We keep going down. You can see the equity in the gray. Okay, so if over here we're going to go to 5,000, it's holding up pretty well. Let's do 6,000 instead. It's holding up pretty well. Let's do 7,000. Still holding up pretty well. 8,000. We're still doing okay. See what I mean? So like, because we changed it to growth first, the margin is the space is growing if we assume a 7% growth rate. I think we can even probably get to 10,000 right here. Oh, it'll be close. So see, we're dipping into the 4,000. So let's do 9,000. See what happens. We're above 50% equity, and then we can always put 10,000 anywhere here probably, and it should be fine. Let's wait till we get to 55% again, just to be safe. And don't look at these goals. These are just sporadic right now, because we haven't put in our true stuff. So you can see here, it would take a lot longer doing this strategy. It'd be 10 years before I get the paycheck or the expenses covered, but this is not including inflation. I'd have to update the chart for that. But anyway, 10,000 reason max out, because we're going to say that's a total paycheck, even if there's increases to it, whatever, just to be conservative. But takes a lot longer, right? So if you are more comfortable with being below 50% equity, which maybe in the early stages I am, that means that I can probably increase it a little bit quicker. So let's see what happens if we do that. So let's say that we were to do $1,000. Okay, so now we see we're getting below, maybe let's say 45% is now our threshold, and we want to invest at 50%. So let's say this is at 2,000. How low do we get? We don't even get to 45. So like 50% here, right? So 3,000. So maybe 45,000. 45% is the new goal, which would help increase it, right? So this spreadsheet is cool that it's set up that way. Like, I can say this is above and beyond my distributions, and anything I put in, I could take out as expense. So that other one was showing 10 years. Let's see what happens if we do this. We're going to keep going. We'll go up $1,000 every time we hit 50%. I'm doing this live with you guys, so this might be like actually what I end up doing. Let's see. And then we'll just, the only difference is I'll use my actual pay numbers, which is a little bit different than this, obviously. Yeah, so 10 grand we would get to around year 6. And when would we end up at 10K? Be year 9. So we're speeding it up a little bit by having a little bit more of a stomach early on for being below 50% equity. Now, that could all change. This is based off of 7%. If we grow at 15%, obviously things are changing a little bit faster, right? The growth is changing, but that means that we would be able to speed up the distribution. So these numbers should stay similar, because it's based off what I'm investing. But if I were to increase what I'm putting in, it should help the equity to hold up a little bit better So we can keep doing that. You know what I mean? Like you just play around with the sheet. But anyways, this is something that I'm thinking about doing, changing up the growth versus the high yield contributions. I'm going to obviously update after the month and after the next distributions. Maybe the next video I do on this will be like, oh, this is the things that I bought. I'm not too sure if I want to do that yet, if I want to show all my cards, but I'm not putting in my entire paycheck yet. So might be okay to show you guys, okay, I bought this and that, and this is why I bought them. So I think next video, that's what we'll do here. But having a lot of fun being part of the community on Blossom on YouTube. You guys are killing it. I mean, we've got over 300 subscribers already. Thank you guys so much for all the love. It's been pretty much all love. Nobody really trolling yet. I guess maybe eventually we'll be due for that, but we'll be able to handle it. But this has been so much fun to just participate in. It's been a little bit of a downturn in the market. It means maybe it's a good buying opportunity for me just to start on this. I mean, growth stocks are being hit as well. It's not like the markets are down crazy. I think the Qs are down like even less than 5% in the last 5 days still. And the S&P similar. So maybe we'll come up with some rules. Maybe that'll be the next video. We'll come up with some rules and we'll say like, okay, at this percentage, this is what I would do. This is how I'm going to change my strategy. Maybe that's be the next one. But I do have a video I want to show you guys about insurance and how maybe I'm going to change up my insurance strategy. I am doing, like I said, SPY puts right now, but they are for flash crashes. I think this other way that I'm thinking of doing insurance is a little bit different. Maybe I'll do a combination, a little hybrid method. But yeah, guys, leave a thumbs up, smash the subscribe button. I hope to see you guys in the next one. Let me know if you guys are living out of your brokerage yet. How did you do it? How did you start? Did you already have a lot of money in the markets and you just converted? Because that's maybe what a lot of people do too. They already had money in the markets and they converted it, and then they don't have to use as much margin to get to where they got to get. I did this portfolio from scratch, trying to build up to living out of my brokerage, and I want to show just how that works. So anyways, guys, we'll see you in the next one. I love you. Bye.